Crypto markets are screaming oversold. Bitcoin just had one of the worst stretches in recent memory. Stocks are holding up, crypto isn't. Jim Cramer is warning. ETFs are bleeding. Altcoins are collapsing. And somehow, Bitcoin's name just appeared in one of the most controversial document leaks of all time. So the real question is not, is Bitcoin crashing? The real question is, what phase of the cycle are we actually in? Today's video is not hype. It's not fear. It's a full 1-hour crypto reality check, backed by data, history, psychology, and macro logic. If you want clarity instead of chaos, watch this till the end. Welcome back to PreyoPromo. This channel exists for people who want to understand markets, not chase noise. Today's video is a full-length crypto analysis course, combining breaking news, viral narratives, macro trends, Bitcoin history, ETF flows, altcoin breakdowns, and long-term price reality. No shortcuts, no clickbait promises, just the truth, whether it's bullish or bearish. Step 1. Crypto massively oversold in market context. The first thing every serious trader needs to understand right now is that crypto markets are massively oversold, not just in isolation, but across every major indicator. RSI, fear, and greed indices, liquidity measures, and leveraged funding rates. According to multiple market reports, the Fear and Greed Index is signaling extreme fear levels rarely seen in the last few years, and overall market cap has retraced sharply toward levels not seen since 2024. Bitcoin specifically has seen one of the sharpest weekly sell-offs, breaking below key support zones like $70,000 and dropping toward mid-60Ks, something we haven't witnessed since the FTX crash era. This isn't just a temporary pullback. This is a technical reset after extended bullish pressure that existed from late 2024 through most of 2025, where BTC climbed to over $126,000 before reversing. The volatility we're seeing reflects deep panic, forced liquidations, macro tightening, and structural shifts in how crypto is treated relative to traditional risk assets. Every crash feels bad in real time. But from a historical standpoint, conditions this oversold have often preceded major basing phases, not just short-term rebounds. Step 2. Jim Cramer warning and sentiment. When a mainstream financial commentator like Jim Cramer starts talking about Bitcoin, especially warning that the price is flirting with a code red level, it reflects not just price action but sentiment extremes. Cramer has referenced critical support like $73,600 and the environmental stress on Bitcoin momentum, which ironically often coincides with local bottoms because most retail investors only pay attention when sentiment is already at a fever pitch. There's also so-called inverse Cramer psychology, where whatever stance Cramer takes becomes a contrarian trade signal. Bearish commentary amplifies fear, causing selling, which typically saturates the downside before relief rallies emerge. This is not financial advice, but purely from a behavioral finance perspective. Commentary from high-profile TV personalities often correlates with capitulation phases, not trend beginnings. Understanding sentiment signals like this helps you avoid trading purely on emotion or headlines. Step 3. Worst week in recent memory. By multiple measures, this recent sell-off in crypto qualifies as one of the worst in recent memory. Bitcoin, Ethereum, and other major cryptos have lost double-digit percentages within a single week. And in some cases, altcoins are down much more. Bitcoin's recent weekly move is reported as one of the sharpest drops since 2023, with Ether down more than 20% and many altcoins trading near multi-year lows. Massive leveraged liquidations, in the billions of dollars, have been recorded across perpetual futures and spot markets, which mechanically pushes price lower as long positions are force closed. A sell-off this intense changes the market structure, not just the price. It drains liquidity, resets funding rates, and forces wide clusters of stops to be hit. This washout isn't pleasant, but it's often a necessary cleansing before volatility compresses and a healthier trend can form. Step 4. Stocks versus crypto disconnect. One of the most underreported themes in this cycle is how crypto's price action has decoupled from major equities at times, especially tech stocks, and then recoupled in others. What that means: when markets bifurcate, crypto often leads downside moves first because it's perceived as the higher beta asset. During this latest sell-off, cryptocurrencies weakened significantly while traditional markets only showed moderate losses, meaning crypto's risk-off response was greater than stocks. This reflects a repricing of how risk assets are valued, where crypto is being treated as a speculative tech proxy, not as a macro hedge or alternative asset. When crypto trades like tech stocks, it becomes fundamentally linked to broader risk sentiment cycles, which can explain why crypto suffers first and often recovers later as sentiment stabilizes. Step 5. Macro liquidity and broader risk. Beyond crypto-specific factors, macro liquidity plays a massive role in Bitcoin's valuation. Analysts have linked recent Bitcoin weakness to tightening macro conditions. For instance, rising bond yields and tighter global money conditions reduce the willingness of capital to stay in high-volatility assets. Higher yields and tighter borrowing conditions have forced many investors to de-risk across risk assets, initially impacting crypto before trickling into other sectors. This dynamic is critical. Crypto doesn't trade in a vacuum. Macro stress affects risk premiums and risk tolerance in all markets simultaneously, whether it's crypto, stocks, or commodities. So understanding Bitcoin's price isn't just about crypto news. It's about macro liquidity, rate expectations, and capital allocation dynamics. Step 6. ETF flows and Bitcoin ETF reality. Bitcoin's narrative shifted in 2024 when multiple spot Bitcoin ETFs launched, bringing institutional access to the market. However, these ETFs haven't been a straight alphas-only pump. We've also seen significant outflows as risk sentiment shifts and macro pressure increases. Cumulative ETF outflows in recent weeks highlight that institutions are rebalancing, not aggressively buying at current compression levels. This isn't a death knell for crypto. It's a reminder that ETFs are liquidity conduits, not price guarantees. They amplify trends both up and down depending on broader risk appetite. Recognizing how ETF flows behave helps you differentiate between structural demand and short-term fear-driven selling. Step 7. Bear case targets and analyst predictions. When markets are weak, bearish analyst scenarios gain traction. And this cycle is no exception. Some prominent investors have publicly warned of deeper downside if current price action persists, citing potential price declines toward lower targets if selling momentum accelerates. One legendary macro investor outlined scenarios where continued price weakness could lead to stress on major holders and mining economics, potentially pressuring markets toward deeper retracement levels. Whether or not these scenarios play out, they highlight one essential principle: markets price probabilities, not certainties. Serious traders prepare for downside risk before speculating on the upside. That's risk management, not fear. Step 8. Mining stress and cost structures. 22 Kaxos 25 Guacasser. Behind the scenes, crypto miners are acting as price absorbers or sellers depending on profitability. Recent data shows miner margins tightening as Bitcoin prices compress, which means some higher-cost miners could be under pressure. When miner margins tighten, selling pressure increases, especially from entities that rely on turning mined Bitcoin into fiat to cover operational costs. Tracking miner economics helps you understand one of the underlying supply pressures that isn't often talked about in surface-level narratives. Step 9. Liquidation cascades and risk reset. 25.28 sur. This current environment saw record liquidation clusters, not just for Bitcoin but across major altcoins, which forced many leveraged positions into auto-closure. Liquidations don't just move price, they reset market structures by clearing leverage, which historically precedes periods of lower volatility and healthier range formation. Forced positions exiting the market reduce risk concentration and can set the stage for normalized patterns where more thoughtful capital begins to re-enter. Step 10. Altcoins breakdown and rotation. 28 ig 31 der. Altcoins have suffered disproportionately compared to Bitcoin, which is a classic sign of capitulation. Ether, Solana, XRP, and many others have seen losses far exceeding Bitcoin's because speculative flows evaporate first from smaller market caps. This isn't unique. Altcoins always exaggerate moves in both directions. Recognizing this helps you avoid chasing high volatility traps during stress cycles. Step 11. Bitcoin trading like a high beta risk asset. 34 Ser 37 Tavericors. Right now, Bitcoin's behavior has shifted. It's acting less like a non-correlated digital gold and more like a high beta risk asset. This means its moves are increasingly tied to broader risk sentiment, equities strength, and macro liquidity conditions. Recent data show Bitcoin sliding in tandem with risk-off cues, where outflows from BTC ETFs have coincided with weakness in tech stocks and economic uncertainty, highlighting its risk asset characteristics. ETF outflows aren't just numbers. They represent capital rotation away from Bitcoin towards safer havens such as cash or bonds when volatility rises. The persistent 3-week streak of BTC spot ETF withdrawals illustrates that institutional demand is not stable right now, which pushes Bitcoin to correlate more tightly with traditional markets. This dynamic reflects a structural evolution. Bitcoin's price is now influenced by macro risk sentiment as much as by crypto-native flows. Traders used to view Bitcoin as a hedge, but under stress, its risk profile looks more like growth equities. This shift fundamentally changes how BTC should be analyzed, especially in stressed periods. Expect deeper downside when equities weaken and crypto inflows dry up. Understanding this risk linkage is key to positioning yourself correctly in volatile cycles. Step 12. Institutional outflows and macro pressure. 37 sur 40 toisos. Institutional behavior this year is arguably the most important macro signal for BTC price structure. U.S. spot Bitcoin ETFs recently posted outflows exceeding $1.1 billion over several sessions, a sign that big players are de-risking amid macro uncertainty. Outflows reversed early 2026 ETF inflows and reflect a broader recalibration of risk preferences, deteriorating demand, and reallocations sparked by macro data like weaker labor figures. This trend tells us Bitcoin's liquidity profile is now macro-driven, not just crypto-native, meaning it will soften when global risk appetite fades. Institutional flows have even shown currency correlation spikes with equity volatility indexes, emphasizing this bridging between traditional and digital markets. This is crucial for pricing models. Bitcoin is no longer an isolated ecosystem. It's part of a larger financial matrix. When macro risk-off signals are triggered, the capital that would normally flow into BTC gets rerouted to safer assets like bonds or cash. If macro sentiment deteriorates further, risk assets like Bitcoin are likely to remain under pressure. This helps explain why BTC is struggling to hold key technical levels despite occasional relief rallies. A macro-aware strategy is essential. Ignoring this link will lead to misjudged risk and premature entries. Step 13. Risk management rules for extreme fear. In markets as volatile as now, risk management is your strongest tool. Not hope, not prediction. When metrics like fear and greed crash to extremes and leveraged positions are wiped out in the billions, that's not a signal to guess a bottom. That's a signal to tighten risk protocols. Extreme fear means retail is selling, weak hands are gone, and volatility is high. But it also means real directional conviction is uncertain. Position sizes must be scaled responsibly. Smaller initial exposure, wider stops outside major structural zones, and clear exit criteria. Diversification matters. Don't let a single asset carry your entire portfolio risk. Use risk-adjusted sizing based on volatility, not price alone. When liquidation clusters form, they tend to overshoot before reversing. This is where disciplined risk rules protect capital. Protecting capital during stress isn't boring. It's strategic. Quick pause here. If this analysis is helping you see past the noise, past headlines, fear, and speculation, make sure you like this video. It tells the algorithm this kind of data-driven crypto content matters. And if you want consistent breakdowns on Bitcoin, macro shifts, and real market structure, subscribe to PreyoPromo. This channel is about surviving cycles, not chasing hype. All right, let's continue. Because the next part is where most people misread the market. Step 14, deeper dive on ETF dynamics. ETFs have transformed how Bitcoin price behaves at scale. They aren't just a channel for institutional money. They've become a barometer of macro risk, reflecting demand or fear in real time. Outflows from BTC ETFs dampen price momentum, especially when markets are already under stress. This has been evident with regular withdrawals in recent weeks, influencing Bitcoin's inability to reclaim higher levels. Historically, ETF inflows supported prices and compressed volatility. Outflows now are structurally amplifying downside moves. This is why BTC's recovery attempts are weaker than in prior cycles. The institutional bid is not as strong right now. Understanding ETF drivers, capital allocation, macro risk appetite, regulatory headlines is essential before making major trades. ETF flows can act as both magnet and repellent, depending on whether institutional confidence rises or falls. During high outflow regimes, Bitcoin behaves more like an asset in de-risk mode than in accumulation mode. This dynamic ties BTC price more strongly to macro news, job data, interest rates, more than in cycles before ETFs existed. Step 15. Long-term structural context. Zooming out, today's environment fits a structural market dynamic that isn't purely short-term crash behavior. Bitcoin's decline from its October 2025 peak near 126K to recent lows reflects a multi-month retracement prompted by the interaction of macro forces, ETF flows, and shifting risk preferences. This long road down is not random. It's a correction of excesses entrenched during prolonged rallies. Longer time horizons incorporate macro cycles, including liquidity tightening, rate expectations, and institutional demand cycles. Even during drawdowns, the network's fundamentals, adoption, hash rate, and transaction activity continue to evolve. Periods like this test structural resilience rather than destroy it. Understanding this helps differentiate between a temporary sell-off and a structural reset. A reset doesn't mean failure. It means the market is rebalancing supply and demand at new levels. Step 16. Practical lessons for positioning. Here's where you pivot from theory to practical strategy. In stressed markets, the best traders don't predict bottoms. They manage exposure and wait for structural confirmation. This means setting tactical zones based on volatility, liquidity clusters, and institutional flow signals. Use macro indicators, like equity volatility and ETF flow patterns, as part of your entry criteria. Define clear invalidation points. If your thesis fails, cut losses systematically. Partial scaling, adding only as volatility compresses, allows you to capture moves while avoiding stress-selling zones. Risk cannot be eliminated, but it can be quantified and managed intelligently. Step 17. What this means for traders versus hodlers. The narrative that HODL always wins doesn't apply uniformly, especially during structural corrections. Hodling is a strategy when adoption and connectivity strengthen long-term, but in a liquidation-driven phase, static positions can erode risk-adjusted capital. Traders need dynamic models that adjust to volatility cycles, institutional flow shifts, and macro regimes. Long-term holders benefit from context, knowing when volatility is compressing and when accumulation is strategic. Both styles require discipline. Traders with tactical risk management and holders with structural conviction. Step 18. Macro links and correlation behavior. Recent macro correlations show Bitcoin's price increasingly tied to legacy markets, particularly equities volatility. The rise in BTC equities correlation underscores how broader financial conditions now influence crypto pricing behavior. This doesn't diminish Bitcoin's uniqueness. It reflects market integration as institutional capital flows and macro risk metrics increasingly intersect with crypto. Understanding this avoids simplistic assumptions that crypto moves independently. Watch risk-off signals. When they spike, Bitcoin often follows. Step 19. Narrative versus reality. There's always a gap between story and data. Narratives like bottom is here or bull market returns now are emotionally appealing, but reality is data-driven. Price action, volume, ETF flows, macro indicators. Right now, data suggests continued stress with intermittent relief rallies. Discount narratives until structural confirmers appear. Like consistently positive ETF inflows, stable macro indicators, and liquidity returns. Step 20. Final strategic summary. In summary, this phase is teaching us a crucial market truth. Risk capital responds first. Narrative capital responds later. Understanding risk, from ETF flows to macro linkages, gives you strategic advantage. Speculating without risk management in cycles like this is a guaranteed capital destroyer. Use layered conviction, tactical clarity for short-term, structural understanding for long-term. So here's the real takeaway. Bitcoin isn't dead, but it's also not ready to moon. What we're seeing right now is a market reset. Leverage flushed, weak hands removed, and price rediscovering fair value under real macro pressure. This phase rewards patience, discipline, and understanding, not emotion. The people who win long-term are the ones who respect structure, wait for confirmation, and manage risk when others panic. If you want clear, honest crypto analysis, without hype, without fear, make sure you're subscribed to PreyoPromo. Thanks for watching. Stay smart, stay patient, and I'll see you in the next one.